WorldCom, the world's second-largest telecommunications company, suddenly collapsed due to an $11 billion accounting fraud. How was such a massive deception allowed to happen? This fraud reached $11 billion, costing 80,000 employees their jobs and causing the stock price to plummet by 99%. Yet, in truth, this failure had structural causes that continue to repeat themselves today. What exactly was this false prosperity? Why did the relentless pursuit of growth become a breeding ground for fraud? Who failed to expose the lies? And what are the universal lessons for modern corporations? This video will reveal all. Now, let's delve into the full scope of WorldCom's collapse. In this main feature, we'll also explain in detail why the auditing firm failed to uncover the deception. In 1983, Bernie Ebbers founded a small phone company called LDDS. His ambition was to disrupt the existing powers in the telecommunications industry. Ebbers pursued an aggressive M&A strategy, acquiring one telecom company after another. The company's name changed to WorldCom, and it rapidly grew into an industry giant. In the late 1990s, riding the wave of the internet revolution, WorldCom's momentum accelerated. The surge in data communication demand provided a powerful tailwind. Then, in 1998, WorldCom acquired telecom giant MCI for $37 billion, becoming the second-largest long-distance carrier in the US, second only to AT&T. The market highly praised WorldCom's aggressive growth strategy. Its stock price continued to soar, and Ebbers became known as the Telecom King. At the time, WorldCom was at the absolute peak of its success. It dominated a promising market, and its scale appeared poised for further expansion. Ebbers consistently presented optimistic growth forecasts to investors and the media, continuing to captivate the market with his charisma. However, behind this dazzling growth, danger signs were already lurking within the company's culture. Yet, no one seemed to notice. WorldCom's growth strategy was simple yet powerful. Acquire existing, aging telecom infrastructure, streamline it, and offer services at low prices. This established a significant cost advantage over traditional carriers like AT&T, allowing WorldCom to rapidly expand its market share. Ebbers consistently executed bold M&A deals, unconstrained by industry norms. He maximized economies of scale, solidifying WorldCom's competitive edge. Furthermore, WorldCom invested heavily in building a fiber-optic network, demonstrating foresight into the internet era. As a result, WorldCom established an overwhelming advantage in data communication services for corporate clients. Many large companies chose WorldCom. WorldCom's business model perfectly aligned with the needs of the era. Up to this point, it was a smooth-sailing success story. With Ebbers' business acumen and favorable market winds converging, WorldCom appeared to have built an invincible telecom empire. Everyone believed in its growth without question, convinced that WorldCom's stock price would continue to rise indefinitely. However, as the 2000s began, the dot-com bubble burst hit the telecommunications industry hard. The market became saturated, and growth decelerated. WorldCom was no exception. Revenues steadily worsened, and the anticipated high growth became unattainable. Amid escalating pressure to maintain stock prices, CFO Scott Sullivan opened a forbidden door. He began capitalizing expenses as assets. This was a violation of accounting principles. For instance, recurring expenses like monthly line charges were treated as if they were long-term investments. As a result, WorldCom's apparent profits inflated, falsely appearing to meet market expectations. Ebbers pressured Sullivan, demanding he maintain the stock price by any means necessary, and CFO Sullivan had no choice but to comply. What began as minor irregularities snowballed as performance deteriorated. There was no turning back. If someone had spoken up at this stage, everything might have been stopped. But here, a hidden trap, unnoticed by all, began to open. Lies begot bigger lies. Driven by intense pressure from superiors and a desire for self-preservation, CFO Sullivan expanded the fraudulent activities. The entire organization was steeped in a culture where growth was absolute. The fear that a falling stock price would cost everyone their jobs was pervasive. Executives, aware of the fraud, chose silence. In exchange for short-term gains, they walked a path toward long-term ruin. This situation was a textbook case of the Concord effect. The psychological reluctance to abandon previous investments and efforts paralyzed their judgment. Even the external auditing firm Arthur Andersen failed to detect this fraud. The quality of their audits had severely deteriorated. Andersen was already under scrutiny for the Enron scandal and should have faced even more rigorous examination during the WorldCom audit. Management's directives were absolute. Disobey and you'd lose your job. Such fear and the instinct for self-preservation completely stifled internal voices. Everyone fell into groupthink, believing this massive company can't possibly fail, and continuously averted their gaze from the unfolding fraud. In June 2002, Cynthia Cooper and others in WorldCom's internal audit department discovered massive accounting irregularities. This was just the tip of the iceberg. Their courageous whistleblowing prompted the SEC, Securities and Exchange Commission, to act. The initial fraud amount, estimated at $3.8 billion, quickly swelled. WorldCom admitted to the fraud, CFO Scott Sullivan was fired, and Bernie Ebbers was forced to resign as CEO. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection. With $41 billion in liabilities, it became the largest corporate bankruptcy in history. Ultimately, the total accounting fraud was revised to $11 billion. This was an unprecedented scale for corporate accounting fraud. Bernie Ebbers was convicted of fraud and other charges in 2005, receiving a 25-year prison sentence. The Telecom king became a prisoner. WorldCom reorganized its business as MCI and was eventually acquired by Verizon. However, its name remained in history as a symbol of corporate deception. WorldCom's failure demonstrates how excessive pressure to meet market expectations can distort corporate ethics. To escape the curse of growth, robust internal controls and independent audits that resist all pressure are essential. WorldCom teaches us why growth became a breeding ground for fraud, who failed to see through the lies, and crucial lessons for modern corporations. WorldCom's failure proved that no matter how large a company, a lack of ethics can easily lead to its collapse. History repeats itself. The lessons from WorldCom should resonate profoundly with today's business leaders and with each of us. There's a distinct difference in decision-making quality between those who understand this failure and those who don't. Let's learn from history and gain the power to shape the future. If you found this video insightful, please subscribe and give it a like. We bring you a new story of historical failure every day. Stay tuned for our next dive into the history of failure. We continuously learn from the mistakes of the past.
この失敗は歴史のほんの1ページ。世界にはまだ語られていない失敗が数多くあります。失敗の歴史をチャンネル登録して次の物語もぜひご覧ください。